Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So today's session is a little special because today we are going to discuss about the NBFCs, the important updates about the NBFCs that we have seen in the last few months. So in 2026, whatever important updates that have been released regarding the NBFCs in the scale-based regulatory framework, as well as there are the changes in the types of NBFC, the type 1, type 2. So all these important updates that have come in the domain of the NBFCs that we are going to discuss in this one video, so that you do not have to search about the important updates of the NBFCs in different videos, as well as we will discuss some core concepts regarding the NBFCs. Okay. So this is important for your RBI grade A, RBI grade B examination also. In the SEBI grade A examination also, this is important because first of all, NBFCs, this is an important topic in your syllabus. And the core concepts of NBFCs are very important for all of you to know. Okay, NBFCs, anyway, you need to know about that. What are NBFCs? What is the scale-based regulatory framework? So that you have the clarity that what are NBFCs. Okay, so let's get started. I hope you are excited for this session because here you will get the idea clear that okay, what are NBFCs and what are the nitty-gritties regarding the NBFCs. So let's get started without any delay. But before that, do subscribe to the EduTap YouTube channel so that you can get the videos that are relevant from your examination perspective, as well as do subscribe to the Telegram channel of EduTap where you will get the PDF of the session. Okay, and the link for the Telegram channel is provided in the description box below. So you will get the PDF in the Telegram channel, for which the link is provided in the description box below. So now starting with the NBFCs. See, RBI in April 2026 has updated the FAQs regarding the NBFCs. So let's discuss the important points regarding the NBFCs. First of all, NBFC, it is a non-banking financial company. So it is a financial company, but it is non-banking. So it is a company that is registered under the Companies Act 1956 or Companies Act 2013 and engaged in the business of loans and advances. That's why it is a financial company that is non-banking financial company, but it can provide the loans and advances. It can acquire the shares, stocks, bonds, debentures, securities issued by the government or local authority or other marketable securities of a like nature, leasing, hire purchase, etc. as their principal business. So these can be the principal business, the loans and advances, the acquisition of shares or the other securities. So these can be the principal business. But for the NBFCs, what cannot be the principal business? So the NBFCs are such companies that does not or do not include any institution whose principal business is that of agriculture activity. So NBFCs, because they are financial companies, so they cannot engage in agriculture activities, they cannot engage in industrial activities, they cannot have the primary business. Mainly, they cannot have the primary business as the agriculture activity or industrial activity or purchase or sale of any goods other than the securities, or providing any services in sale and purchase or construction of immovable property. So remember this, that for the NBFCs, it has been clearly laid down that what can be their principal business and what cannot be their principal business. So for the NBFCs, if an entity is a NBFC, it cannot have the principal business as the agriculture activity or industrial activity or purchase or sale of any goods other than securities, or providing any service and sale or purchase or construction of immovable property. These cannot be the primary business of the NBFC. So I hope this clarity is there first of all. I hope this is clear. Now, okay. So proceeding forward. Now, banks and NBFCs are different entities. Okay, banks and NBFCs are different. So what are the basic difference in between the banks and NBFCs? See, banks, they can take the demand deposits, that are the deposits in your savings account, in your current account. Whenever you want, you can take out the money through your savings account. Okay, using the ATMs, using the UPI, you can do the transactions using the money in the savings account. So demand deposits are those deposits that you can withdraw whenever you want. At 2 a.m. in the morning, if you want to eat ice cream and you are paying through UPI, you are basically using your funds that are in your savings account. These are the demand deposits that can be withdrawn on demand. Now, if the bank also has the fixed deposits or the recurring deposits that come under the time deposits. Time deposits are those deposits that are kept with the bank for a time period, okay. Now NBFCs, they cannot accept demand deposits. So NBFCs, they cannot accept demand deposits. So this is the first difference between the banks and NBFCs. The banks, they can accept the demand deposits and time deposits, but the NBFCs, they cannot accept demand deposits. They can only accept time deposits, okay. NBFCs, they do not form part of payment and settlement system, because through the demand deposits, there are the payments that we are doing, there are the transactions that we are doing. But NBFCs, they are not allowed to handle the demand deposits. That's why they also do not form a part of the payment and settlement system. So NBFCs, they do not form a part of the payment and settlement system. They cannot issue checks drawn on itself also. Now deposit. So the banks, their deposits, like let's say if you're depositing your money in a bank, your deposits are insured with the bank with the DICGC, that is the Deposit Insurance Facility of Deposit Insurance and Credit Guarantee Corporation. So Deposit Insurance and Credit Guarantee Corporation, it insures the deposit that we are doing with the bank till the limit of 5 lakh for each account, okay. So Deposit Insurance and Credit Guarantee Corporation, it is a wholly owned subsidiary of the RBI, which ensures the deposits that we are keeping with the bank. But the deposits, if we keep it with NBFCs, they will not be insured by the DICGC. That is the idea, okay. So how the NBFCs are different from the banks? NBFCs cannot accept demand deposits. They do not form a part of the payment and settlement system. They cannot issue checks drawn on themselves or itself. Deposit insurance facility of DICGC is not available for the depositors of the NBFCs. I hope this is clear. Now, all NBFCs are not entitled to accept public deposits. The NBFCs, they cannot accept demand deposits, but the NBFCs, they can accept time deposits. Now, if the NBFCs, they want to accept the time deposits, they have to take the permission from the RBI. So all NBFCs, they are not entitled to accept the public deposits. If a NBFC wants to take the time deposit, if a NBFC wants to take the public deposit in the form of time deposit, they have to take the permission from the RBI, okay. Now, only those NBFCs that hold a deposit accepting certificate of registration, and if they have a minimum investment grade credit rating of BBB minus from any of the SEBI registered credit rating agency, they are allowed to accept or hold public deposits up to a limit of 1.5 times of their net owned fund. Let's say net owned fund, that are the owned fund of the company. These are the owned funds, net owned funds of the NBFC. Let's say they are 100 crores. So the deposits that they can take is 1.5 times of the 100 crores, that is 150 crores, okay. So this is the idea, that only those NBFCs that have deposit accepting certificate of registration, in their certificate of registration, the RBI has permitted them for taking the deposits. And if they have the minimum investment grade credit rating of the BBB minus. So it's not only that they have a certificate of registration that they can take the deposit, they also need to have a good credit rating, BBB minus or above. BBB minus or above, that means BBB minus or A and such. So BBB minus or above investment grade credit rating they should have, then they will be allowed to hold the public deposits up to the limit of 1.5 times of their net owned fund. So there are two requirements. First, they need to get the permission from RBI to take the deposits in their certificate of registration. They should have the deposit accepting certificate of registration, and their credit rating should be BBB minus and higher, okay. Presently, the maximum rate of interest an NBFC can offer is 12.5%. This is the maximum rate of interest an NBFC can offer. Now, NBFC, they are allowed to accept or renew the public deposits that are the term deposits, which are repayable after 12 months. So, minimum tenure of term deposits that the NBFCs can provide are for 12 months, but not later than 60 months. And the maximum tenure that they can keep the funds is 60 months. Okay. So, if let's say you are doing a fixed deposit in the NBFC, you cannot do the fixed deposit of 3 month or 6 month. No, the minimum tenure of the fixed deposit needs to be 12 month and the maximum tenure needs to be 60. Maximum tenure can be 60 months. Okay, so minimum tenure needs to be 12 months and the maximum tenure can be maximum up to 60 months, not beyond that. They cannot accept deposits repayable on demand, that we have discussed. NBFCs cannot accept deposits that are repayable on demand. Okay, chalo. However, as a matter of public policy, this is important, RBI has decided that only banks should be allowed to accept public deposits because the deposits in the banks, they are insured by the DICGC. So they are more, the public is more protected. The deposits are protected to some extent, at least till 5 lakh at least. Okay. So, however, as a matter of public policy, RBI has decided that only banks should be allowed to accept public deposits and as such has since 1997 not issued any certificate of registration to new NBFCs for acceptance of public deposits. So this is an important point, and in 2026 when the NBFCs FAQs were, the frequently asked questions were updated, so this point was also highlighted that as a matter of public policy, RBI has decided that only banks should be allowed to accept public deposits and as such has since 1997 not issued any certificate of registration to new NBFCs for acceptance of public deposits. So since 1997, the new certificates are not given for the acceptance of public deposits by the NBFCs. Okay, so this is the idea. Any confusion till now? So we have discussed some of the major core concepts, core ideas regarding the NBFCs. Let's proceed with the updates after understanding a few more core concepts, that is scale-based regulatory framework. See, the scale-based regulatory framework basically divides the NBFCs into 4 layers. So this is 1, 2, 3 and 4. So in total, the scale-based regulatory framework, it divides the NBFCs into 4 layers. The higher you go, the more riskier the NBFC is, the bigger the NBFC is. Okay, so regulatory structure for NBFCs by the RBI is the scale-based regulatory framework, in which the NBFCs are divided in 4 layers on the basis of the size of the NBFC, the activity that the NBFC is doing, as well as the perceived riskiness. So the higher you go, the larger the size of the NBFC, the more complicated the activities the NBFC is engaged in, and the perceived riskiness is also higher or can be higher. Okay? So this is the idea that the scale-based regulatory framework divides the NBFCs on the basis of three things, that is size, activity and perceived riskiness. Okay? So NBFCs are divided into how many layers? 4 layers on the basis of size, perceived riskiness and activity. Okay, let's understand that how they are divided. So base layer is the lowest layer, then we have middle layer, then we have upper layer and the top layer. So higher you go, the larger the size of the NBFC, the more complicated the activity the NBFC is engaged in and more perceived riskiness can be there. So base layer is the bottommost layer, it is the base layer. The base layer comprise of non-deposit taking NBFCs. They are not taking deposits, so they are not taking the public funds directly. That means they are not taking the public deposits directly. Below the asset size. Now non-deposit taking NBFCs below the asset size of 1000 crore. So first of all, they are non-deposit taking. That means they are not taking the public deposits. They are not taking the public deposits and they have the low asset size of 1000 crore, below the asset size of 1000 crore. Okay, so below the asset size of 1000 crore. So base layer shall comprise of non-deposit taking NBFCs that have that are below the asset size of 1000 crore. NBFCs undertaking the following activities: peer-to-peer NBFC. Okay, where the person-to-person lending is happening. So the NBFC peer-to-peer platform, it basically provides a platform so that the person that have excess money, they can lend their money to the people that need the money. Okay, so this is NBFC peer-to-peer lending platform where person-to-person lending can be done. through this platform. NBFC account aggregator, they basically share the information from the financial information provider to the financial information user with the consent of the customer. Let's say I want to take a loan from SBI, so all my financial information can be shared with the SBI through the account aggregator with my permission. Non-operative financial holding company, they are basically the holding company that are holding the majority shares or major shares for a company. NBFC holding certificate of registration as a type 1 NBFC. Type 1 NBFCs are those NBFCs that do not have customer interface. They are not taking the public funds. Okay? So these NBFCs, they come under the base layer. Non-deposit taking NBFCs below the asset size of 1000 crore, and these NBFCs on the basis of their activities, okay? So on the basis of size, on the basis of activity. And remember that these NBFCs will always fall under base layer. They cannot fall under middle layer. They cannot fall under upper layer. These NBFCs will always be in the base layer. Next is middle layer. Okay. Now coming to the middle layer. Middle layer shall consist of all deposit taking NBFCs. So all the deposit taking NBFCs, all the deposit taking NBFCs that are taking the deposit of the public, irrespective of their asset size, will come under the middle layer. Non-deposit taking NBFCs with asset size of 1000 crore or above will fall under the middle layer on the basis of the asset size. Okay? So all deposit taking NBFCs, irrespective of asset size, non-deposit taking NBFCs with asset size of 1000 crore and above, they will come under the middle layer. Now on the basis of activities, the standalone primary dealer, infrastructure debt fund NBFC, core investment company, housing finance company, NBFC, infrastructure finance company, they will also come under the middle layer on the basis of the activities that they are engaged in. Remember that why I have highlighted the first and second points. Because these are the two kind of NBFCs that will always be in the middle layer. They cannot come in the top layer, they cannot come in the upper layer, they cannot go to the base layer. These two kind of NBFCs will always be in the middle layer. These other three kind of NBFCs, they can be in the middle layer, they can be in the upper layer, or they can be in the top layer. Okay? So remember this, that the middle layer NBFCs are those NBFCs that are all deposit taking in respective of asset size. Non-deposit taking NBFC with asset size of 1000 crore and above, and standalone primary dealer infrastructure debt fund, they will always be in the middle layer. They cannot go in any other layer. They will always be in the middle layer. Now the core investment company, housing finance company, NBFC, infrastructure finance company, they can be in the middle layer, but they can also go in the upper layer or the top layer. Now coming to the upper layer. So the upper layer shall consist of NBFCs having asset size of 1 lakh crore and above. See, before, for the upper layer NBFCs, there was a different system. Upper layer NBFCs used to be those NBFCs that are the top 10 NBFCs on the basis of asset size, and there was a parametric scoring methodology where there were the quantitative factors and the qualitative factors. So quantitative factors had, I think, 70% of the weightage, and qualitative factors had 30% of the weightage. According to the parametric scoring methodology, whichever NBFCs were considered risky, or these NBFCs have higher risk, according to the quantitative and qualitative parameters, these also used to come under the upper layer. So previously, the methodology was that the top 10 NBFCs on the basis of asset size, as well as the NBFC that are considered risky based on the quantitative and the qualitative factors, will also come in the upper layer. But now this complicated parameters and this complicated structure has been removed. Directly it has been said that the upper layer NBFCs are those NBFCs that have the asset size of 1 lakh crore and above, and they are identified by the RBI. Okay? And they are annually placed in the upper layer. So that is the idea. So upper layer shall consist of NBFCs having asset size of 1 lakh crore and above. Now top layer will ideally remain empty. This layer can get populated if the RBI is of the opinion that there is a substantial increase in the risk from specific NBFCs in the upper layer. So if see, as you go higher, I have told you that as you go higher, the more risky the NBFC is. So there are the NBFCs, the big NBFCs, the large NBFCs, because the asset size of 1 lakh crore and above, they are kept in the upper layer. So now if RBI feel that the risk of the upper layer NBFCs is increasing, they will be kept in the top layer. They will be put in the top layer. Top layer, basically, if the NBFC is put in the top layer, that means there are more rules and regulations that the NBFC has to follow. So the higher the layer you are going, that means the more the rules and regulations you will have to follow. The more the rules and regulations you will have to follow. So top layer NBFC, the top layer of the NBFCs should remain ideally empty. This layer can get populated if the RBI is of the opinion that there is a substantial increase in the potential systemic risk from specific NBFCs in the upper layer. Okay, such NBFC shall move from the upper layer to the top layer. Move from the upper layer to top layer. Okay. Now, which NBFCs will only come in the base layer? So these are the 4 kind of NBFCs on the basis of the activities that will only come in the base layer. And this is on the basis of asset size. Which NBFCs will only come in middle layer? These 2 NBFC categories will only come in the middle layer with the asset size kind of NBFCs. Okay. Chalo. Now, type 1, type 2 NBFCs. Type 1 NBFCs are those NBFCs which do not have the customer interface and they do not take public funds. Till now, any confusion? So now we have discussed about the scale-based regulatory framework. So now we will discuss the type 1, type 2 NBFCs. Okay? See, the type 1 NBFCs, they are those NBFCs that do not take the public funds and they do not have the customer interface. Type 1 NBFCs are divided into 2 categories: registered type 1 NBFCs and unregistered type 1 NBFCs. So basically RBI has said that if the asset size is less than 1000 crore and the NBFCs, they are not taking the public funds, they are not having the customer interface, then these NBFCs can be unregistered NBFCs. So if the asset size is less than 1000 crore and the NBFCs are not taking public funds, they are not having customer interface, then they will come under the type 1 NBFC and they can remain unregistered. That is the idea. So they are not taking public funds, they are not having the customer interface and their asset size is less than 1000 crore, then they are exempted from registration requirement with the RBI. But let's say that the NBFCs, they are not taking public funds, they are not having the customer interface, their asset size is equal to or more than 1000 crore. So then they need to be registered type 1 NBFC. If they are not taking public funds, they are not having customer interface, but they have the asset size of 1000 crore or more than 1000 crore, they need to be registered with the RBI. They need to be registered with the RBI. That means they need to hold the certificate of registration. Okay. Now, type 2 NBFC is basically the NBFC that is taking the public funds and having the customer interface irrespective of asset size. Whatever the asset size is, doesn't matter. If the NBFC is taking the public funds or is having the customer interface, it will come under the type 2 NBFC. If they are taking the public funds or if they are having the customer interface, they will come under the type 2 NBFC, which compulsory needs to get registered. Okay. So if an NBFC does not avail public funds, has no customer interface and has an asset size of less than 1000 crore, first of all, this is type 1 NBFC. Which type 1 NBFC? Registered or unregistered? Unregistered type 1 NBFC, because they do not have the public interface, public funds. They are not having the customer interface and they have the asset size of less than 1000 crore. So they are exempted from section 45 IA, that is, they are exempted from the requirement of registration and net own fund, and they are exempted from the requirement of reserve fund. So you can understand that if you are an unregistered type 1 NBFC, so you do not have these requirements. This is the idea. Moving forward, additional information. Okay. Because the higher you go, this is Harshira, this is what I have told you, that if you are in the base layer, then middle layer, then upper layer, and then the top layer, the higher you go, the stricter the rules and regulations the RBI will be applying. Now, top layer should ideally remain empty. So that means the NBFCs will lie in base layer, middle layer, upper layer. Now, the upper layer will have the strictest stricter rules and regulations in comparison to base layer and middle layer. If the NBFCs are kept in the top layer, then even higher rules and regulations will be imposed. So the higher you go, the more riskier the NBFC, the larger the NBFC can be, as well as the higher the rules and regulations will be by the RBI. That is the basic idea of the scale-based regulatory framework. Okay. Now, NBFC upper layer shall be mandatorily listed. Now, if a NBFC is in the upper layer, it shall mandatorily be listed within 3 years of its identification by RBI in the upper layer. So, if a NBFC is put in the upper layer, let's say this XYZ NBFC is kept in the upper layer, has been added in the upper layer. So, within 3 years, it needs to get listed in the financial market, in the stock market. Okay. So an NBFC upper layer shall be mandatorily listed within 3 years of its identification by RBI in the upper layer. That is the idea. But if it is a government owned NBFC, it can come under the NBFC upper layer, but it do not require to get listed within 3 years. It do not have this provision. So these provisions, that is the NBFC middle layer, shall be mandatorily listed within 3 years of getting in the NBFC upper layer. So these provision will not be applicable to NBFC upper layer which are fully owned and controlled by the government. So government owned NBFC, they are fully owned and governed by the government. So even if they are in the NBFC upper layer, they do not need to get listed in the financial market. Okay. Now, the criteria for further identification of NBFC upper layer is what? That is asset size. Now, the criteria for identification of upper layer has been amended, and basically it has been said that to identify the NBFC upper layer, you just have to see that the asset size is 1 lakh crore or above. So this criteria for identification of NBFC upper layer shall be reviewed periodically, because this asset size criteria, it needs to be reviewed periodically. Further, the asset size threshold for identification of NBFC upper layer shall be reviewed every 3 years. So whatever is, like this asset size parameter is, the asset size should be 1 lakh crore or above. So this has to be reviewed every 3 years. Now it has been said that the whole criteria for identifying the NBFC upper layer shall be reviewed periodically. Further, the asset size criteria, it needs to be reviewed every 3 years. So first of all, the identification criteria has to be reviewed, that are we using the correct asset size, or are we using the correct method of identifying the upper layer NBFC. Then the asset size limit or threshold should also be reviewed every 3 years. That is the idea. Chalo. Once an NBFC is categorized as NBFC upper layer, it shall be subject to enhanced regulatory requirement. This is what I told you, that if a NBFC is placed in the higher layers, in the upper layer basically, then the NBFC will be subject to enhanced regulatory requirement for at least for a period of 5 years. So once an NBFC is categorized as NBFC upper layer, it shall be subject to enhanced regulatory requirement. The higher regulatory requirement, the higher rules and regulations it will have to follow for at least a period of 5 years from its classification in the upper layer. Even in case it does not meet the criteria in the further years, let's say in 2026 it has the asset size of 1 lakh crore and above, but in 2027 it does not have such large asset size, its asset size decreases. But still, if it is placed in the upper layer, it has to fulfill, or it has to follow the higher rules and regulations for the period of 5 years, even if in the subsequent years it is not fulfilling the criteria. So that is the idea, that if you have entered the upper layer, like if a person has entered the jail, they have to fulfill their tenure in the jail, or they have to fulfill their time in the jail. Similarly, if the upper layer has entered the if the NBFC has entered the upper layer, it will have to complete its tenure of 5 years. So once an NBFC is categorized as NBFC upper layer, it will be kept under the enhanced regulatory requirement for a period of 5 years from its classification in the upper layer. Even in case it does not meet the criteria in the subsequent years, doesn't matter. In other words, it will be eligible to move out of these enhanced regulatory requirement framework only after the period of 5 years, only after the period of 5 consecutive years. That is the idea. So this is regarding the discussion regarding the core concepts and the updates that we have seen in 2026. So I hope you have got the basic idea about the NBFCs. You have got the basic idea that what are the major updates that have happened. The upper layer classification have changed. The upper layer criteria for identification has changed, and it has been said that it will be reviewed every 3 years. Then there is also the type 1, type 2 NBFCs that have been clarified. Now, what are type 1 NBFCs? What are type 2 NBFCs? Then there is also the clarification regarding the government owned NBFCs, that government owned NBFCs, they can be in the upper layer, but they do not have this mandatory listing requirement. Okay, so government owned NBFCs, they can be in the upper layer, but they do not have this mandatorily listing criteria. Okay. Chalo. Now try to answer the questions. These are your homework questions that you have to answer in the comment section below. With reference to the scale-based regulatory framework for NBFCs, consider the following entities: that standalone primary dealer, infrastructure debt fund, NBFC, housing finance company, NBFC account aggregator. Which of the above can never be placed in the upper layer under the RBI's regulatory structure? So remember this, that there are specific NBFCs that will always come in base layer. There are specific NBFCs that will always come in middle layer only. They cannot be placed in the upper layer. If you have understood this clearly, if you have understood these base layer and middle layer criteria clearly, then you will be easily able to answer the question that which of the above can never be placed in the upper layer under the RBI's regulatory structure. Okay. Chalo. Now, which one of the following statements regarding acceptance of public deposits by NBFCs is not correct, or which of the following statements regarding the NBFCs is not correct? Eligible NBFCs may accept public deposits up to 1.5 times of their net owned fund. Public deposits may be accepted for a tenure ranging from 12 months to 60 months. Interest may be paid or computed at rest month shorter than monthly rest. So remember this, that the interest can never be in the shorter than monthly rest. So actually here C is the answer. I've told you this answer because this is something that we had to discuss. Okay, so interest may be paid or compounded at the shortest of the months, not less than that. So that means interest can be paid or interest can be compounded on the monthly basis, quarterly basis, a semi-annual basis, or the annual basis, not on the daily basis basically. So interest may be paid or compounded at rest not shorter than monthly rest. This is since this is the other statements are correct. Now, since 1997, RBI has prohibited all NBFCs from accepting public deposits. So this is correct, and the other statements are correct. Okay. Chalo. Now, this is it for today. Thank you, everyone. See, with the forced listing, it is basically saying that the big NBFCs, they need to get listed so that there is clear they are also following the SEBI rules and regulations, and they are also, because they are the big NBFCs, so they should be listed for their fair value to be seen in the market. Okay, so this is the idea. Okay, then thank you everyone, thank you for joining the session. Now we will meet in the next session. Okay.